everyone, welcome. You're watching Market Cafe on ET now. This is Priyanka along with me, Snehi. Before we go further, wishing all our viewers a very happy Diwali, a very auspicious, prosperous, wishing you and your loved ones a very happy Diwali. Now, we did get some sign of exhaustion on Indian markets again. FIs again did a big selling yesterday and minor losses, modest losses, what we saw in US markets also. Get you cues from US, Asian markets and all the stocks that will be buzzing in trades today. But let's get started with the US markets, wishing Snehi also very happy Diwali.
Absolutely. Happy Diwali to you, Priyanka, and very happy Diwali to all our viewers as well. Let's kickstart the show with the global handover and talk about what the US has been up to yesterday, because it's been a slightly somber trading day coming in for the US markets. Yes, if you take a look at Dow Jones, that was down 0.2%. S&P 500 was also down by 0.3%. Nasdaq, however, slightly more than 0.5% decline coming in for Nasdaq as well. And the US VIX was up more than 5% yesterday, so that's a little sign of a caution coming in. But well, yes, somber day coming in for the markets. Nasdaq was more than 100 points lower in yesterday's trading day. Let's understand what's happened and why this has happened, because in after hours action you had Meta platforms that dropped 3% after missing the street expectation when it came to its earnings. Microsoft revenue guidance disappointed investors as well, dragging shares nearly 4% lower as well. Now, investors also weighed in the third quarter US GDP product reading. We'll be telling you more about that later as well, which showed the economy grew at 2.8% annualized rate, falling short of that 3.1% that the street was penciling in. So that's another reason, another catalyst that was weighing on the markets yesterday. And also the personal consumption expenditure price index for September, that's also going to be important to watch for, because it happens to be the Fed Reserve's preferred inflation gauge. It's their preferred metric to gauge inflation and take policy action on the basis of that. Now, economists polled by Dow expect that the PCE has grown by 0.2% on a monthly basis and 2.1% from a year earlier. The PCE reading, along with Friday's October payrolls report, will in fact inform the Fed's interest rate decision on November 7th. So these are going to be two major events that are lined up today and tomorrow, and running up to the Fed's announcement, the interest rate announcement that will come on November 7th. Remember, Fed has started taking some cuts coming in. They have been turning more cautious on what's been happening with the market. So this 7th November meeting is also going to be very crucial to watch out for as well. Now, tech earnings will continue for Wall Street today. You have tech giants like Apple, Amazon that will be coming out with their numbers today. Uber, Merck, Intel, all of them are going to be coming out with their numbers today. And also on the economic front, you have the weekly jobless claims data coming out from the US today. So that's largely how the US has closed, looking slightly somber for the US markets. But if you take a look at what the European markets were up to, well, they have taken a much steeper cut than what the US markets have done. DAX is lower by 1.1%, FTSE lower 0.8%. You have CAC lower 1.1%, and overall stock 600 also deeply under pressure, 1.2% cut coming in on that index as well. So US looking somber, Europe looking even weaker than the US. Our GIFT Nifty also implying that we're going to have a subdued start today. Let's see how these global cues pan out for our markets today.
So weaker kind of guidance that has come in from Meta and especially Microsoft, that has weighted on
the market,
US market. Well, let's see what the next week also fares out. November 5th presidential election, and then 7th November is what the Fed is going to do. Further, all eyes on that. But then in the meantime, oil prices, they have rebounded on Wednesday, rising more than 2% after especially the data that showed that the US crude and gasoline inventories, that has fell unexpectedly last week. And there were also reports that OPEC Plus may delay a planned oil output increase. So nearly falling off for more than 6% earlier in the week, on majorly on the reduced risk of wider Middle East war. Brent crude futures now have settled $1.43 or nearly 2% at 72.7 a barrel. Now, talking about the gold also, but then gold prices, they rose to a record high as yet. The gold is actually, all that glitters is actually gold, we must say, for the gold. On Wednesday also, we saw a surge in prices. Spot gold that rose to 0.5% to precisely $2,789 per ounce after reaching an all-time high of $2,789 earlier in this session. In fact, US gold futures also have gained by 0.7%, and now they're trading at $2,799 per ounce. That's the check on the crude as well as gold.
Absolutely, lots to watch out for. In fact, in the occasion of Diwali, gold has been sparkling really well, acting as a safe haven. Actually, given the way the markets have been acting. But on that note, let's also take a look at the important events to watch out for in today's trade. Back home, you have the weekly and monthly Nifty expiry today, given it's the last Thursday of the week as well as the month. From the US, like we told you, the PCE inflation as well as the initial jobless claims are due today. From Eurozone, the inflation print in the form of CPI will be out along with unemployment data. From China, the manufacturing and non-manufacturing PMI, both of those are going to be some important metrics to watch out for when it comes to China. But shifting focus to Japan, the Bank of Japan rate decision is going to be announced today. It's going to be very important to watch out for, given everything that's been happening with the yen, especially in terms of yen carry, and when you take a look at the dollar as well. You also have industrial production and retail sales data coming in from Japan today. In terms of global earnings, like we told you, Amazon, Apple, you also have MasterCard, Linde as well as Shell coming out with their numbers today. But back home, in terms of corporate action, you have IFL Finance that will be in focus because the board will be mulling fundraising today. It's also the last day to buy shares of GCPL and Tech Mahindra to be eligible for their dividend. Remember, the record date is tomorrow, which makes today the last day to buy these shares to be eligible for dividend. So watch out for all of these events in today's trade.
Okay, so that's a check on US markets, gold and crude. But now let's get you some more global stories. And the biggest talking point this morning is the US Q3 GDP numbers, which has come in lower than in the expectation. Now, the US economy that have posted yet another disappointing period of growth in the third quarter, largely propelled by strong consumer spending that has defied expectation for a slowdown. Now, gross domestic product means GDP during these 3 months period from July through September, that has increased at a 2.8% annualized rate, whereas expectation with what economists were penciling in, they were expecting an increase of 3.1%. Remember, in the second quarter also, the growth stood at 3%. So we have fallen short of last quarter's growth. Now, the report confirms that the US expansion has continued despite elevated interest rates and even long-standing worries that the burst of fiscal and monetary stimulus that carried the economy through the COVID crisis, that would not be enough to sustain the growth now. So it looks like a concerning factor, hence what we did on the markets.
Absolutely. And it's a very important metric to watch out for as well, and has a very understandable reaction on the way Wall Street has reacted today. But let's also shift focus to earnings and get into detail of the Meta as well as Microsoft earnings. Now, Facebook parent Meta delivered a weaker than expected Q3 number and warned of significant acceleration in its infrastructure expenses in 2025. Sales were up 19%, while net income grew 35% year over year, representing the company's lowest year-on-year growth since the second quarter of 2023. Meanwhile, let's shift focus, talk about Microsoft as well. That has reported a beat on Q3 earnings for the fiscal first quarter. However, the stock plunged despite the beat as the company forecasted slower growth going forward.
All right, keeping it with earnings only, Samsung Electronics, that one has reported a mild beat on Q3 sales and even operating profits. However, company's chip business that took a hit, posting a sharply lower profit versus the previous quarter. Now, the semiconductor unit that one delivered a decline of 40% versus the previous quarter.
Okay, let's also keep it going with earnings once more and talk about Starbucks, because the global coffee chain has reported a miss on revenue estimates for the third quarter on the back of disappointing sales from the US as well as Chinese markets. These earnings, remember, mark the first under newly appointed CEO Brian Niccol, and Niccol has outlined a multi-part plan to improve the company's US business immediately.
Okay, shifting focus to some important comments also. Post-election state of America, that worries now US billionaire Ray Dalio, who called for reforms numerous times amid a political landscape rift with what he view as irreconcilable differences between both Democratic as well as Republican parties. Now, speaking at the Future Investment Initiative conference that held in Saudi Arabia, the founder of the investment firm Bridgewater Associates spoke about major geopolitical as well as the election-related concerns. The issue of rising US deficit as well as how investors can best position their portfolios were the main talking points.
Okay, we're just getting news coming in from China right now. We did speak about keeping an eye on PMI, and we have those numbers coming in now. China's official Purchasing Managers Index for October has come in at 50.1 in the expansionary territory for the first time since April. Now, remember, anything below a 50 indicates a contraction, where China has been for a very long time. Some stagnation was seen on that front, but now China has a reported PMI of 50.1, so looking good. But other than that, Shanghai is also dipping 0.2%, but let's see if these numbers are able to lift the sentiments of that index on the street. Now remember, the reading was expected to come in at 49.9. September's reading was 49.8, which means October's reading that comes up above 50, even though it is just incrementally above 50, bears very well for China and the terms of manufacturing that we're seeing. But yes, it's looking good for China in terms of the PMI, but let's see if that reflects on Shanghai today as well.
Just technical, it's just shy of the 50 mark, which is a sign of contraction. Okay, moving on, I'm talking about Ayodhya that hosted its first Diwali with a grand celebration of Lord Ram's homecoming. Uttar Pradesh government was felicitated with 2 new Guinness World Records, one for the most people performing Diya rotation simultaneously at the same time, and another one for lighting over 25 flag diyas in Ayodhya's Ram Mandir. Processions featured scenes from the Hindu epic Ramayana, with artists from 6 countries participating in the same. Now, the event had a stunning display of fireworks, drone shows, and even traditional folk dances. It was indeed unlike any celebration seen in previous years.
Well, India seems to be celebrating Diwali in full rigor, and like it should be, because it is finally the festival of lights that's dawned upon us. But on that note, we'll slip into a very short break. We'll bring you what Asian markets are up to on the other side, so you stay tuned.
Welcome back. You're watching Market Cafe on 80 now, and now let's get you some cues from Asian markets. And of course, Asian markets, the 2 key cues which all the traders were eyeing on was, of course, the China's official PMI index for October month, which has come in at 50.1. That is in expansionary territory for the first time since April, and this would be the 6th straight month of, in fact, watchable period for the country's manufacturing sector. Other key event which traders are keeping an eye on is the Bank of Japan's rate decision. Now, economists which are expecting the Bank of Japan to hold rates at 0.25%. Well, at this moment, Japan is down by 0.5%. Now, BOJ, this one is very crucial because Bank of Japan is expected to hold the rates at 0.24%. And though there would be the key cues to watch out from will be the statement that, will it be passed for any clues for the timing of its next rate hike or not. Before this, one more key data which came in from Japan was not a very good data. Japan's retail sales, and this looked like weighing on the Japanese market also. Japan's retail sales, that one missed expectation, and that marked the slowest rise in over 2 years also. The retail sales, which grew only by 0.5% year-on-year in September month, that was sharply lower from the revised 3.1% rise in the August month, and that's what looks like weighing on the market also. And of course, the weak sales, this clearly makes it harder for the Bank of Japan to raise rates. Let's get you the other markets also, how other markets are reacting right now. For Hong Kong, the futures, the Hang Seng Index, that one stood nearly 20,500 mark. Above that, 0.5% up. Hang Seng Index right now trading at, and let's get you Kospi. Kospi is down by 0.5%. So mixed set of cues coming in from Asian market also. Looks like a little somber day from here also, because weak cues from US markets. Indian closed at a weaker note. Asian markets cues are not that very strong. Yes, the only relief is that what has come in from the China's PMI data, and Shanghai is also trading flat to red. And of course, the GRIF Nifty is indicating a softer start. In fact, 68 points. This one has increased. I think before this it was earlier 30 points. Now it's the narrow down is increasing now.
Absolutely, 24,340 is where we've closed yesterday. 24,303 is where penciled into starts, so slightly lower than the level that we've closed even yesterday. And cues from Asia also not looking very supportive. Global cues, like Priyanka mentioned, also looking very weak. But on that note, here's everybody who's going to be joining us on the market today, starting at 9:20. We'll be joined by Rajesh Bhatia, the CIO at ITIMF. It's going to be an interesting conversation to beat the street and try and see pockets of value amid a market like this. For the FII 8th edition, we'll be joined by Yashish Daya at 9:40. He belongs to PB Fintech, and it's also going to be making up for some very interesting conversation. We'll be kick-starting the earnings roundup at 9:50 a.m. We'll be joined by Sailesh Mehta, the chairman and managing director of Deepak Fertilizers. And well, to highlight the consumption pulse amid this festive season at 10:20, we'll be joined by Vipul Parekh, the co-founder and CMO at Big Basket. Along with that, we'll also have Jayant Mehta, the managing director at Amul India. So lots of interesting market guests and managements lined up for you. Stay tuned to the market today. Hi there, welcome back. Thanks so much for still staying tuned to Market Cafe. You're watching ET Now. Let's bring you some fresh action coming in from SEBI, because SEBI has proposed that asset management companies should specify timelines for the deployment of funds collected under new fund offers, popularly known as NFOs. Anurag Joshi is here with all of those details. Anurag, take it away.
The Securities and Exchange Board of India has unveiled a consultation paper seeking public comments on the use of money collected by mutual funds through new fund offers. The paper wants asset management companies to mention the achievable timeline in the scheme information document of the product, and the funds to be deployed according to an asset allocation scheme that the fund devises for the product, and also to make a plan to garner the funds accordingly. The AMC may be mandated to use the in NFO funds within a period of 30 working days, while the investment panel of the AMC may extend the timeline by another 30 business days. SEBI is seeking public comments on the consultation paper by November 20.
Thanks very much, Anurag, for all those details. Keep a close eye on this. We'll come back to you for any updates on that. Let's now take stock of how indices and even stocks move in the month of November. Swamit is standing by with some interesting data that he's collated over the years. Take it away, Swamit.
So we have seen the seasonality for the month of November over the last 10 years, and what we have understood here is that in the month of November, Nifty indices on an average has closed in green around 6 times, while the average return for the Nifty 50, which is the benchmark index, has been close to 2% When it comes to the broader indices, they have performed much better compared to the benchmark. In fact, Nifty mid cap and the Nifty small cap index both have closed in green around 8 times in the last 10 years, and the average return for the month of November has been around 3%. Now, if you look at the sectoral indices, there is the Nifty Bank Index, Nifty Media, Nifty PSU Bank Index, which have closed in green around 8 in the last 10 November month, while the average return has been close to 2 to 6%. When it comes to FMCG, financials, IT, private bank and real estate indices, they have closed in green around 7 times, while the average return have been anywhere between 2 to 4%. Now, when it comes to Nifty Auto, Nifty Metal, Nifty Energy and the Nifty MNC Index, they have closed in green around 50% of the time, that which is nearly 5 out of the last 10 Novembers, and the average return have been close to 2 to 3%, while Nifty Pharma and Nifty CPSE Index have closed in green just 4 out of the last 10 times. Now, Nifty Pharma has given an average negative return of around 0.6%, while the Nifty CPSE Index has been flat in the month of November. Now, this is the most interesting part, where we have seen the stocks that have closed in green most times in the month of November, and that is Tata Communication and Persistent, because they have closed in green nearly 9 out of the last 10 Novembers, and the average return has been anywhere between 6 to 7%. Birlasoft, Apollo Hospitals, SBI, IndusInd Bank and Biocon have closed in green around 8 times, while the average return is close to 5 to 7%. While on the negative side, if you look at, UPL has closed in green just 3 times, Cipla has closed in green just 2 times, while SBI card has never closed in green in the month of November. Now, for SBI card, there has been an average negative return of 3%. For Cipla, also average negative return of 3%, while when it comes to UPL, it has given an average return of negative 2% in the month of November.
Okay, Swami, thanks so much for taking us through that. But while you're with us, also take us through what we can expect from the auto sales figures for the month of October. It's seeming to be largely mixed, because on one side, we're expecting two-wheelers and tractors to have seen a seasonally good month on the back of festive demand, but we're expecting some pressure on the CV segment. Swami, tell us what we can expect from these numbers.
Well, the October auto sales would be important to track, given the fact that festive demand will also be partially reflected in this month. But do remember that the entire demand for festive is not coming in the month of October. Some of this will also fall in the month of November. Now, for the October month, if you look at the wholesale sales, they are likely to be mixed. We'll see some growth when it comes to the two-wheeler and the tractor segment, while we are expecting a flat overall performance for the passenger vehicle segment and a decline when it comes to the commercial vehicle segment. Now, festive season, however, on the retail side, the festive season retails are positive for two-wheelers, tractors and passenger vehicles, as per various channel checks done by the brokerages. Now, if you look at segment wise, in the commercial vehicle, Tata Motors is expected to see the biggest decline on a YY basis, around 10% of a decline in the wholesale sales, while for that of Eicher, VECV is expected to remain largely flat, and for Ashok Leyland, a minor decline of around 1% is expected on a YY basis. When it comes to two-wheeler, it's Eicher Motor which is expected to see the biggest jump in its wholesale sales both on a month-on-month and YOY basis. On a YOY basis, they expect to see a 16% growth, followed by TVS Motor, which will report a 10% growth. Then there is Hero, which could report a 6% growth as per analyst expectation, while for Bajaj Auto is expected to be largely flat, just 1% growth. When it comes to passenger vehicle, it's M&M which is expected to report the highest growth of nearly 9%. Then there are other three passenger vehicle companies like Maruti, Tata Motors and Hyundai, which are expected to report a decline on a YOY basis. When it comes to the tractor segment, it's Mahindra and Mahindra which could report a 2% growth, while for Escorts a 1% growth is expected. And largely when it comes to the three-wheeler segment, we are expecting a decline from TVS Motor of around 19%, but for Bajaj Auto, analysts are expecting an 8% growth on a YOY basis on three-wheeler sales.
So it looks like some respite for a particular category in the auto basket, not for the whole. JP Morgan also came up with a similar kind of report yesterday. But Swami, do tell us, there's an interesting note which has come in from Jefferies. There were expectations about the muted set of earnings from this quarter, but the report also highlights about that. In fact, this is the highest downgrades ever since 2020, what the report says. Give us more details.
Well, Jefferies has come out with this India equity strategy report where they're saying that finally the supply side, which is the selling that we are seeing in the market, is now matching with the flows that we have been seeing from the domestic investors in the market. Now, they are saying that there is a strong domestic demand for equities, which has finally matched up with the supply side. Now, equity supply has ramped up to nearly $7 billion on a monthly basis on an average that we have been seeing for the last 4 months. And they're saying for the calendar year 2024 so far, they have calculated a supply of nearly $60 billion that we have seen in the Indian equity markets, and they're expecting this supply side, higher supply side or the outflows to continue at least for the near term going forward, and they're expecting domestic flows are now picking up. So that could be a concern coming in for the Indian equity markets. They're also saying that the 2024, if you look at the equity flow as a percentage of household saving, that is also at its higher level, and hence they're expecting some peaking out on the domestic flows going forward. They continue to remain cautious when it comes to the equity markets, and they are bullish on sectors like banks, two-wheelers, healthcare and telecom. Other than that, they are not very much bullish on the other sectors. Now, post the result season, they have also upgraded their rating when it comes to the IT sector to neutral, and they have added Coforge to their model portfolio. And this IT sector upgrade that they have done is largely to factor in the improved economic data coming in from the US market and the falling probability of a steep rate cut that US Fed could do going forward. However, this upgrade in IT has been taken by downgrading consumer staples, and they have downgraded consumer staples to neutral from overweight rating, and they have cut their weightage when it comes to Godrej Consumer. Other than that, one more change that they have done in their model portfolio is they have added Max Healthcare and they have removed Apollo Hospital. Now, they are saying that Max Healthcare is available at the same valuation and is offering higher growth when compared to Apollo Hospital, and that's the rationale behind adding Max Healthcare and removing Apollo Hospitals.
Okay, Swami, thanks so much for joining us early this morning and giving us so much information. Thank you so much. Let's move on and bring on board my colleague Ria because she has the earnings roundup of L&T. Time to take stock of some quarterly earnings. And Ria, when it comes to L&T has reported a beat on revenues and EBITDA while profits were largely in line. Break down what these numbers are and take us through the earnings fine print.
Yes, Nehi. So let's take a look at how the numbers have panned out for L&T in the second quarter of FY25. Now, the revenue has gone up around 20.6% on a year-on-year basis versus our expectations of a 13% year-on-year growth. So, clear beat coming in there. On the net profit front, that is up around 5.5% on a year-on-year basis, in line with our expectations. EBITDA is up around 13% on a year-on-year. Clear beat versus our expectations of a 9% growth. If you talk about the margins, the margin has come in at 10.3% versus 11% last year, down around 70 basis points on a year-on-year basis, but still in line with our expectations of a 10.66% margins. If you talk about the orders, order inflow has come in at rupees 80,000 odd crores, down 10% on a year-on-year basis, but 13% up on a sequential basis. Very strong order book as well, over rupees 5 trillion, with the share of international orders at 40%. Now, there's also some management commentary on this front. They've said that the H1 FY25 order inflow was down 2% versus last year, but they've still been able to maintain the order win rate. The H1 domestic ordering momentum has been muted due to the union elections and the new government formation, but the order prospect pipeline stands at rupees 8 trillion, and going forward they do expect the domestic orders to pick up momentum in H2 of FY25, and the international order inflows continue to remain strong. If you talk about the infra projects segment, that segment has secured order inflows of around 49,500 odd crores, up around 77% on a year-on-year basis, and the margins over here have come in at 6% versus 5.4% last year, so a good improvement there. Improvement of 60 basis points in line with our expectations. Some other management commentary as well in the energy segment. Specifically, they've said that they expect the carbon light and the green energy segments to pick up pace going forward, and they've also highlighted that the company is broadening into Africa and Central Asia markets as well, which is going to augur well for growth going forward. If you talk about the guidance for FY25, that has been maintained. Order inflow at 10% year-on-year growth, revenue 15% growth, and core margins at 8.2%. Now, on the back of this, we have two brokerages commenting on the results. Bernstein has maintained the outperform rating with a target price of rupees 3,891, and UBS has also maintained their neutral rating with a target price of rupees 4,000. So that is where the numbers stand for L&T in this quarter. So definitely keeping an eye out on the stock in today's trading session.
Right, thanks very much, Ria. So order inflow on a sequential as well on a year-on basis. There's a growth. The brokerage reports also. In fact, management also spoke about that. Second half looks better. We did speak to L&T CFO R. Shankar Raman, and who mentioned that the company is expecting momentum of domestic orders to pick up in second half of FY25. Let's listen in.
So we did anticipate a 3 to 6 months moderation in terms of the momentum. And true to our expectation, it did play out that way. And hence, the order intake from the domestic market for the half year is roughly about 1/3 of the total order intake that we are reporting for quarter 2. The orders that the company won during Q2 is about 800 billion rupees. Looking ahead, we see a fairly healthy prospect in terms of pipeline between now and March of 25. We expect the domestic orders, which so far in H1 have remained flat, to pick up momentum. But going forward, we expect carbon light solutions as well as green energy to pick up pace. So the skew towards hydrocarbon projects will get somewhat moderated.
That's the commentary coming in from the CFO of L&T. But on that note, let's bring in Ria back on board. And Ria, thanks so much for staying on. While you're with us, also take us through the list of all the stocks that could be in focus in today's trade.
Yes, so we do have a lot of stocks in focus today. First up, we have Biocon in the back of their Q2 FY25 numbers. Now, quite a weak set coming in from Biocon here. While the revenue has gone up around 3.7% on a year-on-year basis, on the profitability side, there's been a very weak performance. The net loss has come in at 16 crores versus a profit of rupees 125 crores last year. Even the EBITDA is down around 7.6% on a year-on-year basis, and the margins have also contracted by around 233 basis points, a weak set for Biocon. Tata Power, that has reported an inline good set of numbers. Revenue has gone down marginally 0.3% on a year-on-year basis, but the net profit is up around 7.4% on a year-on-year basis. Even the EBITDA has gone up around 21% over the previous year, and the margins have seen a very healthy expansion of 422 basis points, coming in at 23.9% in this quarter. Let's also talk about two pharma stocks on the back of the US FDA action. So firstly, for Biocon, the US FDA has classified Biocon Biologics drug substance facility at the Biocon campus in Bangalore as voluntary action indicated, and for Cipla as well, the US FDA has classified the inspection of the manufacturing facility in Goa between the 10th and the 21st of June 2024 as a voluntary action indicated. Lastly, we also have Zaggle Prepaid in focus today, since they've entered into an agreement with Dr. Batra's Positive Healthcare Private Limited, and with the Zaggle is going to provide Dr. Batra's clinic with the Zaggle Zoya proposition. They've also entered into another agreement with TBO Tech Limited, and this partnership agreement with TBO is for travel and related services along with solution integration, and this partnership agreement is going to offer business travel for Zaggle's clients through TBO Pax's interface. So definitely keeping an eye out on all of these stocks today.
Thanks very much, Ria, for highlighting all that stocks that could be buzzing in trade today. Moving on, the central government's fiscal deficit expanded to 29.4% of the target in the first half of this fiscal year to come at 4.75 lakh crore. Now, the fiscal deficit that one narrowed from 39.3% in the same period last year, while the total receipts that came in at 16.37 lakh crore rupees. Data showed that overall expenditure in the same period was at 21.11 lakh crore.
Okay, let's keep it going with the macros then, because India's core sector growth has rebounded by 2% in September on a year-on-year basis after it had fallen to a 42-month low of 1.6% in August. 5 of the 8 sectors, coal, steel, cement, fertilizers and refinery products, have reported a production increase in September. Now, refinery and cement sectors have led the gains when it comes to these numbers as well.
All right, with this, we stay for a short break. More to come on the other side. We get you more brokerages on the other stocks. We'll get you even rural consumption, more input brokerages have penciled.
Hi there, welcome back. You're still watching Market Cafe. Now, it's Diwali and it's the festive season. We've also had Navratri a few days ago, and we're going to have Christmas also coming in a month's time. So, in fact, lots of festive activities are in focus, and one of them, the big theme that comes across during festive season, is the consumption of electronics particularly, and overall consumption as well. We have the brokerage firm Equirus that has come out with a channel check on the consumption trends that they have seen over the course of the festive season, and they say that the first 3 weeks of October were muted with high single-digit to low double-digit growth. However, things have materially changed for the good over the last 7 to 8 days. They're seeing a strong pickup in demand, leading to 18 to 20% growth for the large format stores and the players in that segment. They say that general trade channel would have grown by roughly 2%. However, sales have picked up across channels as well. When it comes to large appliances, they're flagging off that RAC, which is the room air conditioner, has seen the most growth in that category at 25% plus. Washing machines have grown at roughly 18%. However, there's been a relatively slower growth for refrigerators, but it is still in low double digits. When it comes to small appliances, there's been a 15% growth across categories on a year-on-year basis. The fastest growing of them are air fryers, chimneys, hobs, fans, as well as water heaters. Now, food processing categories like mixers and juicers are growing, albeit at a slower pace. If you take a look at everything that's been happening across geographies and region-wise growth, the West and North are witnessing abnormally strong growth. South is relatively softer. You have Andhra Pradesh, Telangana and Tamil Nadu that are doing well. Karnataka and Kerala market, however, are subdued this time around. East is the weakest geography when it comes to pan-India growth. And lastly, they're also eyeing a roughly 20% growth during the current festive season versus last year. So that's Equirus' channel check on what consumption trend is looking like this Diwali compared to the last.
So there is some slowdown, but then let's not forget, Sneha, if you remember, speaking about the same note, JP Morgan also came in when they gave us a note on auto sales, and they spoke about that the festive trends have improved over the past 1 week. So let's see if this creates any positive sentiment. But Gaurav is joining us to give us an idea of how the brokerages look like today. Morning, Gaurav.
Well, yes, there are a lot of companies where DAM Capital has actually initiated. What they have done is that first let's talk about the OMC companies. First let's talk about ISCL, BPCL and HPCL, where they have initiated with buy rating. For ISCL, they have given a target price of 181 rupees. For BPCL, it's 395, and for HPCL, it's 440 rupees. What they're saying is that oil marketing companies are going to gain. What they're saying is that marketing margins are going to improve from here on. The risk of rising oil prices is a little low, and at the same time, what they believe is that the refining environment will see a significant improvement, and as a result they are being bullish on this space. Next, let's talk about steel sector. They have initiated on JSPL, JSW Steel, Tata Steel and SAIL. On every company they have initiated with the buy rating and a huge target price. What they're saying is that the Chinese steel spreads are actually falling, and when we talk about the Chinese players, they are also seeing some kind of slowness in the supply, and that is the reason why they believe that Indian players can actually benefit from this region. Apart from that, what they say is that India can actually be a major growth driver for steel industry across the globe, and at the same time protectionism is something which is playing out well for India, and that is the reason why they are bullish on these companies. And lastly, let's also focus on AB Capital. We yesterday saw a good set of numbers from the company, and now Macquarie has maintained outperform rating at a target price of 285 rupees. What they say is that when we talk about AB Capital, AB Finance Limited, there we saw a big beat, but when it comes to their insurance arm, which is AB Aditya Birla Sun Life Insurance, we saw a little bit of weak numbers. VNB margins continue to decline. What they're saying is that credit cost was lower because of the higher PCR ratio that we have seen, but overall a bullish view is what they have maintained on AB Capital with a target price of 285 rupees. So all in all, definitely watching out on all these companies on the back of the brokerage note that we have received in the morning.
Okay, Gaurav, thanks so much for taking us through that. Let's shift focus and talk about yet another earnings candidate. And numbers came very close to closing bell yesterday, and I'm talking about FMCG major Dabur. Now, if you take a look at their overall set, it's a rather muted set of numbers coming in, and this is what we were largely expecting also. But let me take you through what the fine print looks like. And if you take a look at these numbers on a consolidated basis, you have the revenue that has in fact come in at 3,029 crores compared to 3,204 crores, which is down 5.5% on a year-on-year basis. This is largely in line with what we were expecting at ET now. Net profit, however, has missed our estimates by a whole 5% because they've come in at 425 crores compared to 515 crores, which is down 17.5% on a year-on-year basis. So a miss coming in on that front. If you take a look at the EBITDA has come in at 553 crore rupees compared to 661 crore, which is down 16.4 on a year-on-year basis. Slight miss from what we were expecting. However, EBITDA margins have come in at 18.2% versus 20.6%, a decline of 238 bips in line with what we were expecting. If you take a look at some other earnings fine print, the India FMCG business has seen a 7.6% volume drop. We were expecting this number to be 8%. The international business has also grown 13% in constant currency terms. If you take a look at the volumes on a year-on-year basis, segment-wise, home and personal care has dropped by 8.1%, healthcare is down 9.8%, and food and beverage is also down 20.7%. However, this is something that we were expecting to happen for the quarter that went by. If you take a look at some other highlights, there's moderation in urban demand. High food inflation has led to slowdown in consumption. This is what the management has flagged. Heavy foods and natural calamities have impacted consumption as well. But quick commerce is growing at a rapid pace. Now, rationalization of the inventory in the general trade channel has led to a temporary dip in Q2 sales. However, Badshah Masala was up 15% year-on-year in value terms. Lastly, the big announcement that came in from the company was the acquisition of Sesa. Now, Dabur will acquire a 50% stake in haircare company Sesa Care Private Limited for an enterprise value of 315 to 325 crore rupees. They'll be paying 12.6 crores right now to True North, the existing owner of the company, and shares of Dabur will be issued in exchange for these shares and the remaining 49% stake. This merger is set to be complete in 15 to 18 months. Very quickly, what the brokerages are making of these numbers. We have a note coming in from Goldman Sachs this morning. They've maintained a neutral rating with a target price of 580 rupees. They're highlighting the sharp decline in Q2 EBITDA that was driven by channel destocking, and even if you adjusted for inventory reduction, the growth was weak due to sharp decline in beverages. It's been a weak quarter for the India beverages segment as well, as fruit-based beverages lose share to aerated drinks category. However, the management expects mid to high single-digit growth in the second half, but contingent on strong winter. So that's the roundup coming in on Dabur's Q2 numbers.
So it looks like urban consumption is slowing down. That's what was seen in Marico's number as well as in Dabur's number. All right, with this, it's a wrap on Market Cafe, but don't go anywhere because markets take more action.
If you like this video, then like, share and subscribe to ET Now.